Nothing about this price is real anymore. For years you've been told that gold and silver trade freely, that prices rise and fall based on supply and demand. But here's the contradiction. The numbers you see on screens have almost nothing to do with what it actually costs to own the metal. The market still looks alive, trades still clear, charts still move, yet underneath, the connection between price and reality has been quietly severed. This didn't happen overnight. It happened step by step. First, delivery became optional. Then contracts stopped requiring metal. Cash replaced substance. And over time, a system designed to move real goods turned into one that moves promises instead. Most people never noticed because nothing forced the issue. But now it is being forced. If price no longer reflects access, then price stops being information. It becomes theater. And when that happens, anyone relying on those numbers to protect savings, plan production, or preserve value is exposed without realizing it. Here's the part most coverage avoids. This isn't a glitch, it's a structure. And once you understand how it works, you can't unsee where it's heading. Because when reality finally collides with paper, the adjustment isn't gradual. It's violent. What you're seeing now is the surface of a much older pattern. This isn't about one bad trade or a sudden shock. It's about how the pricing system itself was redesigned decades ago. Futures markets were once built to move real metal from seller to buyer. Delivery mattered. Settlement meant transfer. Over time that changed. New instruments were added, options, electronic trading, layers of leverage that made it easier to trade exposure without ever touching the asset. The result was subtle but profound. A market emerged where most contracts no longer ended in metal. They ended in cash. That shift allowed massive volumes to trade without being constrained by physical supply. Prices could be pushed, pulled, and stabilized without testing reality. As long as no one demanded delivery at scale, the illusion held. But notice what that structure encourages. It rewards speed over substance. It favors institutions that can move size, create synthetic supply, and exit before pressure builds. Meanwhile, signals from the real world, industrial demand, supply bottlenecks, inventory stress, get drowned out by derivatives volume. So ask yourself this: if the price is set in a market that doesn't require the thing it's pricing, what exactly is that number measuring? Because once enough participants start asking that question, the system doesn't just wobble. It redefines what price is supposed to mean. Here's the first hard proof that this isn't theoretical. Inside this system, practices that should be rare became routine. Large orders appear, disappear, and reappear within seconds, creating the illusion of supply or demand that never actually exists. Prices move on signals that vanish before anyone can act on them. At the same time, contracts are sold without the seller ever holding the metal behind them. On paper, supply looks endless. In reality, nothing new is produced. This matters because it explains why prices stay suppressed, even when demand is visible. When synthetic supply floods the market, it overwhelms real signals. Short positions multiply without metal ever changing hands. The market clears, but nothing is delivered. That's not efficiency. That's distortion. Notice what's missing from this picture. Enforcement. The rules exist, the behavior is known, yet consequences are rare, delayed, or symbolic. That absence isn't accidental. It allows scale, it allows repetition, and it allows the same players to profit from volatility while the structure itself remains untouched. This is where the story flips. Because once participants realize that supply can be created with keystrokes, trust in the pricing mechanism erodes. And when trust erodes, the market stops being a tool for discovery. It becomes a battlefield. The reason this keeps happening isn't mystery. It's permission. Over time, the barriers that once limited risk were removed. Lines between traditional banking and speculative trading blurred, then disappeared. Institutions that held deposits gained the ability to gamble with them. Size became protection, influence became insulation, and accountability faded quietly in the background. What followed was predictable. A small number of players accumulated positions so large they could bend prices simply by acting. Regulators existed, but rarely intervened in real time. Rules were written, but enforcement lagged just long enough to make them irrelevant. Each cycle reinforced the same lesson. If you're big enough, the system adjusts around you. This created a market that looks competitive but isn't. Power concentrates. Smaller participants are shaken out through volatility they can't survive. Meanwhile, the underlying structure stays intact because challenging it would mean confronting the institutions that benefit most from it. Here's why that matters now. Once legal and regulatory guardrails weaken, the only remaining constraint is physical reality, and physical reality doesn't negotiate. When enough pressure builds, it doesn't correct politely, it snaps. Now the fracture is visible on the global map. For the first time in decades, prices stop agreeing with each other. The same metal trades at sharply different levels depending on where you are. Western markets still display familiar numbers. Eastern markets don't. They reflect what buyers are actually paying to secure delivery. That gap isn't noise, it's a signal. If this were a normal arbitrage, traders would close it instantly. Buy low in one place, sell high in another, but that isn't happening because the bottleneck isn't money, it's metal. Moving physical supply has become difficult, slow, or outright impossible in some channels. When arbitrage breaks, it means the market is no longer unified. This is the line that permanently changes how you see price. A global commodity with multiple prices isn't being mispriced, it's being rationed, and rationing only appears when scarcity is real. Notice what this also implies. If one pricing center loses authority, another gains it. Power shifts toward markets that require delivery, not promises, toward places where contracts end with metal, not cash. Once that shift begins, it doesn't reverse quietly. It rewrites who sets the rules. What happens next isn't financial, it's strategic. When metals move from being tradable assets to classified necessities, governments stop watching and start acting. Supply chains become security concerns, stockpiles become leverage, and access to raw materials turns into a question of national priority. That shift is already underway. Instead of relying on global markets, countries begin locking down supply. Exports slow or stop. Domestic production is pushed forward even when it's expensive or politically difficult. Projects that once moved slowly are fast-tracked, not because they're profitable in the short term, but because dependence is risk. This is where the pressure multiplies. Industrial users are now competing with governments for the same material. The market isn't just balancing buyers and sellers anymore. It's balancing states, corporations, and security planners, all pulling in different directions. Speed becomes everything. Whoever secures supply first stabilizes, whoever waits pays more or goes without. That dynamic doesn't create smooth price moves. It creates gaps, shortages, and sudden policy shifts. And once supply becomes a weapon, the market stops pretending it's neutral. It becomes contested terrain. The stress shows up where systems are weakest. Distribution breaks before production does. Dealers can't restock. Orders get delayed, then refused. Not because prices are too low or too high, but because there's nothing available to move. When even large buyers are told to wait, the signal is clear. Inventory buffers are gone. This exposes a flaw that was easy to ignore when markets felt liquid. Supply chains were optimized for efficiency, not resilience. Metal flows just in time, not just in case. That works until demand spikes or transport tightens. Then everything seizes at once. There's no slack to absorb the shock. What makes this worse is how supply is sourced. Most silver isn't mined on its own. It's a byproduct. That means output can't ramp quickly, no matter what the price does. You can't flip a switch and get more metal. The lag is structural. So when demand surges, whether from industry, investors, or governments, the response isn't higher supply. It's competition. Buyers crowd each other out. Availability, not price, becomes the constraint. And when availability disappears, panic doesn't need encouragement. It arrives on its own. Some people believe this is all headed toward a controlled outcome. The idea is simple. Let prices rise, but not too fast. Allow metals to reprice just enough to absorb pressure, stabilize balance sheets, and coax supply back into circulation. In that view, higher prices aren't a failure, they're a release valve, a managed reset that keeps the system intact. But here's the risk in that thinking. Control assumes cooperation, it assumes supply responds, it assumes confidence returns once numbers adjust. None of those are guaranteed. If higher prices trigger hoarding instead of selling, the opposite happens. Metal leaves the market faster, scarcity deepens, the release valve becomes a trigger. This is the uncomfortable truth. You can manage perception, you can influence price, but you can't command trust once it's gone. If participants believe access will get harder tomorrow, they don't wait for policy. They act today. And once behavior shifts from calculation to preservation, models stop working, plans stop mattering. Because at that point, the system isn't negotiating with traders. It's reacting to fear. From here, the system faces a credibility test it can't postpone. If exchanges continue operating without guaranteeing delivery, they survive in name but lose purpose. Contracts still trade, prices still print, but serious buyers move elsewhere. Direct deals replace centralized markets, bilateral agreements replace benchmarks, the old reference points stay visible, but they stop being decisive. The alternative is confrontation, a moment where delivery is demanded at scale and the system has to choose between honoring obligations or rewriting them. That choice doesn't need to be announced to be felt. A single suspension, a single forced cash settlement, one visible failure is enough to change behavior everywhere. Neither outcome is certain yet. What's forming is momentum. Quiet decisions by producers, buyers, and intermediaries are already narrowing the range of possibilities. Every ounce locked away reduces flexibility. Every workaround signals fragility. What matters now isn't what officials say, it's what participants do when they're not on record, where they source, what they hold, what they no longer trust, because the next phase won't arrive as a theory. It will arrive as an action already taken. Here's what this all resolves into. This isn't a story about metals winning and currencies losing. It's about a system that spent decades separating value from substance, finally running into a world that still runs on physical limits. When claims grow faster than reality, stability depends on nobody asking hard questions at the same time. That condition no longer holds. What comes next won't look like a single collapse. It will look like divergence. Two versions of price, two standards of trust, one based on access, the other on appearance. Most people won't notice the shift immediately. They'll feel it through delays, premiums, and decisions that suddenly feel tighter than before. This is why moments like this matter. They don't announce a new era with fanfare. They quietly change what works and what doesn't. And by the time it's obvious, the adjustment has already been made. If you want to understand these shifts before they harden into reality, stay here. Follow for the next layer of analysis. Because the most important changes are rarely the loudest ones.